Welcome back, guys. It looks like we finally have some action in the cryptocurrency markets, but it seems like that's on the back of the news, the latest news from the Fed as they look to raise interest rates, which of course is putting pressure on the rest of the market. But of course, my overall view for the market is that we are in a long-term bull market leading into 2026. And I know this is not the mainstream view of the markets. People are looking for crashes this year, 2022. They were expecting crashes in the market in 2020 and 2021 and 2022 across property, stocks, crypto. And sure, we saw a decent crash in 2020, but the market bounced back from that low and we have never seen those prices again. And so in this video, we're going to look at the news items and of course the cycles. The most important part is the cycles. At least that's in my analysis and the way I've been trading the markets for over 10 years now and being in property and investing for 15 years. And the more that I see this happen, the more that it continues to play out. Maybe it's my own bias, but long story short, when the cycle is up, there is nothing that will get in the way of the cycle. This is something that I've been talking about for years on the channel and something that I mention to our members on a weekly basis. It's pretty important to continue to understand what's going on in the market, but more importantly, looking at the cycle, knowing where we are in the cycle to best time it. Yes, time the cycle as best as we can. Now, of course, we're not going to get it to the exact minute or hour, but we're going to get it broadly speaking. And that's what we look at when we discuss Wyckoff analysis, Gann analysis, and of course, our charts in general when we're reading the charts. So without further ado, make sure you smash the like button, subscribe to the channel if you haven't already, hit that bell notification icon, and you can join us on Patreon or Premium. Links to this are in the description down below. Now, TI Premium is the trading course, probably something good to look at if you are looking for something to do across these holiday periods. Learn about trading, learn how to read the charts, and join us on a weekly basis to learn more about the cycles at play. We look at the 18.6 year cycle, our 80 to 90 year cycles, and plenty of other smaller time frame cycles as well, as all of this stuff continues to come together time and time again. Now, I've probably got it titled something around the Fed just crashed the crypto stock markets, because that's what happens with the news. You get these news announcements, markets drop by a few percent, everyone freaks out. The long-term cycle is still intact, and I see this as another fantastic opportunity to be entering the market if you haven't already, or if you've got your plan. These are times to be entering on extreme fear, as we will see in just a moment. We are looking at the fear and greed plan, and it hit 15 today. If you've been following the channel, you know what that means. But before we dive into that, let's get across some of the news headlines, all of the fear that's out there. The Fed just crashed it. People expecting crashes in 2020. Let's wait and see what happens from that point. So the main thing I want to draw your attention to, which is something we've looked at many times, is the wall of worry. As markets go up, there's usually a wall of worry. There's worry around every damn corner that you would expect the market to crash. And sure, if you're new into the markets, if you are a new investor over the last couple of years, you wouldn't have seen enough to understand that markets climb the wall of worry. And as you get around, or as you're around investing for a cycle at least, that's usually around 17 to 23 years. If you're around a cycle that long, or go and study history, you will see the wall of worry happen every single time. New investors will always get caught out, and people, I'm sure, will say that I'm wrong, the market has to crash this year, you're not understanding X, Y, Z in terms of the fundamentals. I hear you. I've seen it all before. I may be wrong. I'm happy to be proven wrong. But at this point, the market still continues to climb the wall of worry based on my analysis. And of course, at the end of the day, this is how I am trading the market, how I'm investing in the market. And if that person chooses to invest a different way, then we're all free to do so. But you're here wanting to understand my opinion on the markets based on what it is that I'm seeing. So the wall of worry is something that is a bull market feature. The market continues to climb and all of the worrying news comes out. Today is just another one of those pieces of news. The Fed and all the investors are anticipating that the Fed will raise interest rates. And of course, this is sending stocks lower at this point in time. Fed officially discusses raising rates sooner and faster in 2022. This is something that does happen in the cycle. We'll see these low interest rates. If it raises 1-2%, it's not going to affect things too much because the cycle is still up. Now, what does this mean? It may become warranted to increase the federal funds rate sooner or at a faster pace than participants had earlier anticipated. Now, I think a lot of people had anticipated this. At least that's part of the professional investors that I watch. They have anticipated this already. So I think after the initial shocks of the market, maybe this lasts several weeks to several months, eventually the wall of worry kicks in and that wall continues to climb. So officials might then move to further cool off the economy by reducing the size of their balance sheet. And what does that mean? What does that look like? By the Fed letting the bonds it's purchased reach maturity and run off its balance sheet. So it's effectively created the money it used to buy the bonds out of thin air. Then the Treasury Department pays the Fed at the maturity of the bonds by subtracting the sum from the cash balance it keeps on deposit with the Fed, effectively making the money disappear. So they created the money out of thin air and then they effectively make the money disappear. Essentially, it's just part of the cycle. This happens every single time. Let's look at the NASDAQ. And of course, it's sent some scares into the market, 3% down. But if we zoom out, where have we come from? This is the flu variant. Well, actually, it wasn't the variant then, but this was the flu low in March of 2020. We continue to zoom out on a daily. You can see just how far up we are. And people are expecting big crashes again. I don't believe we'll see one. Happy to be proven wrong, but we could basically fall all the way as far as 11,700 and still be within a strong section of this bull market. Not sure if we'll get there, but that gives us a lot of leeway to move. And of course, this will then drop a lot of the stocks. Of course, that's why this index would drop. This is the NASDAQ. That would drop. Obviously, you're going to have a lot of people probably going to buy up, I think. These are all tech stocks and lead into that next stage of the cycle. And as I've said before, I see this going into mid to late 2020s, around that 2026-ish area based on Phil Anderson's work that we've looked at many times. And I'll look at that in just a moment, the 18.6-year cycle. If we throw this onto a monthly, you can see just how far up we've come. And sure, a lot of people are saying that's exactly why we should see a major, major crash. But 2022 is not the year for a crash, as I've pointed out many times before. We've seen this in 2012. I'll look at on the S&P 500. This is 2012, and you can see the market's taken off again. This is 2002, so 20 years earlier. The market then took off in 2003, 4, 5, 6, 7 into that peak in a double top. Then we had the major crash of the GFC, and then the market's obviously taken off again. So although this was extreme panic and pretty bad times for a lot of people, the market has since doubled, tripled, quadrupled all the way from those low points. Now, I don't think this is going to happen. This is still several years away. One of these major, major crashes will come again. It always does, but it's a long way away. 20 years ago, this was another panic time in the market. 1992 basically was a little bit of a sideways year. Not much happened there. So 30 years earlier, and the market still took off into new highs into 2000. 1982, so we look back 40 years, we had more panic. So we can see panic in this year, but in terms of the world being over and no more opportunities, the markets should crash. It's just too early at this point in time. So we do have these fearful periods in the market. They may last several weeks to several months, and then the cycle continues on. So that's what we've been looking at for quite a long time as well, and I still see this going up. So Fed may have crashed us a couple of percent, but in the grand scheme of things, it is not very much at all. Looking at the Aussie market, of course, the Aussie market will react to the US markets as well, and it's down 1.17%, so not really that much, and we're still well above the previous all-time highs of 7,100, and then our previous highs back in 2007 was around 6,800. So we're still quite a long way above those at the moment. So that's still all looking fine. Yes, we do get the panics. And of course, the panics bring on the extreme fear. Now we're at 15 on the extreme fear. Finally hit that 15 mark, and that mark basically means as part of the fear and greed plan, which is a longer term plan to be buying in to, in this case, Bitcoin, but if you go and test it across other markets, you might find that it does pretty well on those markets too. Looking just to buy on these extreme fear times. So we're still up about 26%. This is all purchases done through May, June, and July, and we finally got another 15. So here's another $1,000 thrown at it at around 43,400. The Bitcoin is 0.023, so approximately 0.023, and our total amount of Bitcoin now is 0.3768. So you can see that the average price is around 34,800, and profit still 3,400. So it gives us another opportunity to be buying in. In terms of Bitcoin, you can see it's dropped to this current low. It's just a couple of $100 off. I would expect that would probably take out these lows eventually. It's 39,042. I wasn't so sure just a couple of days ago, but as we've dropped straight down, if we take them out, we take them out, and this just extends the sideways, the accumulation period for Bitcoin and cryptocurrencies. And honestly, I think it works in quite well with the narrative for this year, according to, if I'm looking at some of these articles here from FTX CEO SBF Sam Bankman-Fried, believes 2022 will be a year of regulatory clarity. So the way I see this is if we are getting regulatory clarity, that is going to slow down the growth, but in the short term. But of course, with that regulatory clarity, then more projects can start to build and we begin to grow yet again. So I see this as a positive. I know it doesn't sound like it at the time, but if we're getting this clarity, this takes time. This will slow things down. And that looks pretty similar to what's happening on the chart, getting a slowdown. We're keeping higher prices, keeping that overall bull market intact as these $28,000 lows remain. And if we continue to hover and accumulate, then that just works in with what's going on in the industry. Now, I also had a conversation with some other cryptocurrency exchanges, some of the big players, and they're also looking at 2022 as being a regulatory year. So they're also seeing the same thing that Sam's talking about here, getting regulatory clarity. And this is across many other countries, Hong Kong, Singapore, US, the big names, the big players here where these companies are getting set up. So if we're getting that clarity, again, basically just looking for the market to continue to build out during this period. Ethereum is actually in a stronger position than Bitcoin. Bitcoin has broken that 50% level. It's heading towards, well, it can head towards that $36,000 level, still be strong. And then of course those lows that we see at around 28,000, as long as they stay intact, we continue to get this sideways accumulation, still looking good. Whereas, as I said, for Ethereum, it has broken that December 4th low, but we're still above our 50% level, and we still have the 2,400 level intact as well. And then, of course, the lows at 1,700. So we're still a long way off that, and I just think this is going to prolong. The upside for ETH, of course, is how much ETH is getting burnt. And we also have the Google Trends. Crypto's on the way up, so we've got higher lows. Look at the last 12 months worldwide, getting those higher lows forming. It's interesting to see how much interest is still in crypto, even though the prices are down and kind of sideways and boring. If I throw up the 5 years, you can still see that we're continuing to get higher lows here as well. The lows, the highs are lower, but the lows are getting higher and higher and higher. So that's a good sign. We can break down, we can still be above these levels. It's still a good thing here with more interest coming. And we just have this cooling off because that's what happens in the market. Looking at the cooling off, part of that is Ethereum 2.0 taking a while to come out. Vitalik has said that we're about 50% of the way to getting ETH2. So I don't expect it in 2022. I'm pretty sure it's not a big prediction there from a lot of people. This could take another several years. As Vitalik says here, when asked to evaluate Ethereum's progress made so far in the past 6 years, Buterin asserted that we are 50% of the way there. So if it's taken 6 years to get 50%, maybe we'll take another 6 years to finish the 100%. I think it might be sooner than that. Once the merge and surge go through and there is full sharding implementation, then it will supposedly be 80% complete. The roadmap roadmap, which is estimated to take another 6 years to complete, will lead to 100% optimization according to Buterin. So they're still saying another 6 years to get to 100%. Either way, I think the layer 2s are going to obviously help Ethereum at this point. But looking at layer 1, this is all just playing into that extension of the cycles. There is still growth. Things take time. It's exactly what we are seeing. In terms of some good news, Bitcoin hash rate hits new all-time high. So that just means that the Bitcoin network is the most secure it has ever been in its entire history. That to me doesn't show that people are leaving this market, and it seems like it's still very profitable for miners to continue to mine, especially during these periods when the market is kind of quiet. Looking at money flowing in and out, we have money flowing out this week, but it's not much at all. We had 3 weeks of money flow out after about 16 or 18 weeks of money coming in. In terms of a percentage, barely anything. It's about 0.04 of assets under management that flew out in this last week, and that came from Ethereum, multi-assets, and everything else that had an inflow, money coming in. Binance came in, Solana came in, Polkadot, Cardano, Tron, Ripple, it's all still coming in, Bitcoin as well. So that's still looking good. The overall market, this is the 18.6 year cycle, 2021 to 2024. We're still getting a lot of real estate activity, real estate cycle in full swing. You can find this at propertysharemarketeconomics.com, 18.6, 2021, 2024. So as we said here, 2025, 2026 is where we're looking for the decline in vacancy rate. So this is where the market starts to turn. And we'll see some of these signs in the stock market flow out onto the property market. In terms of crypto may peak earlier than this, and the money will flow across into stocks and into property. But for now, this is what I've been following since 2013, and it has been on the money. It has been on point for the last 9 years that I've been following this. So when I hear about a lot of scares that the market should crash in 2022 or 2021 or any other year prior to that, been following this, and it has been absolutely on point. So this is this comes together from Phil Anderson, Gann's work, and Fred Harrison's work as well. So there's a lot of work in here, over 230 years of data, and this comes together in a nice, clean to understand cycle clock. You can see this happen in the US as well. US home prices up 18.4% in October. So this is news just last week. So the property prices are up. Americans borrowed record 1.6 trillion to buy homes in 2021. And then for Australia, property prices are up huge here. Brisbane, including the Gold Coast, one of the biggest, if not the biggest. So year on year, 28.4% up. Doesn't sound like a lot, but when you add in the leverage that people are buying property, putting your 100 grand or 200 grand down to get your loans of $500, $1 million, then of course that's a lot of percentage gain on the cash itself. So that's what you have to understand when it comes to property. So that's pretty much the cycle at this point in time. We've seen a lot of worrying news. The markets will climb a wall of worry, and until that point, it's looking like good opportunities if you've got yourself a plan, you're following something like a Fear and Greed, or if you've joined us on TIA Premium, TIA, or on Patreon as well. You can find out on a weekly basis. Go and check out the links in the top of the description. I'll see you guys at the next video. Until then, have more fun to get more done.